This is Nightly Business Report.
Getting close. The Dow has its second highest close ever as investors play past those federal spending cuts.
Buffett speaks. The billionaire investor answers questions from NBR viewers and tells why he thinks stocks are still relatively cheap.
And the American recovery, a special In Focus report on what's working in the U.S. economy, what's not, and why. Good evening and welcome to our public television viewers. I'm Tyler Matheson.
And I'm Susie Garib. Good evening, everyone. Stocks reverse course and the Dow is closing in on a new milestone. This comes on the first business day of the sequester, the start of billions in automatic federal spending cuts. Investors bought up stocks, though, with the Dow posting its second highest close ever, up 38 points to 14,127. It's just 37 points from its record high. The Nasdaq added 12 and the S&P added 7 points. Bob Pisani has more on what helped drive today's action.
The Dow rallied nearly 100 points midday off its lows on not much news, but it wasn't enough to hit historic highs. We fell about 37 points short. We were led by financials. Now we're going to find out which ones passed key stress tests later in the week. Oil and energy stocks also bounced off of their lows today, but it wasn't really enough to overcome the growth scare around China. Chinese authorities put the brakes on the secondary property market over the weekend, and anytime that happens, commodity stocks get hurt because less real estate development over there hurts copper, cement, iron ore, and steel stocks. Indeed, commodity and big industrial names weighed on the markets all day. Finally, I would note Apple was down another 2.5% today, closing near the lows of the day and a 52-week low. The hot stock right now, it's Google. It's up nearly 2% to an historic high. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Today's market gains likely made Warren Buffett happy. Then again, he usually seems pretty cheerful. Today, he told CNBC that even at today's near-record prices, he still sees values in stocks.
I think they're undervalued relative to other assets. In other words, if I had a lot of money today, I would rather own equities than own fixed dollars, long-term government bonds, junk bonds, farmland, REITs. They're not as cheap as they were 4 years ago, but you get more for your money, and that's why we like buying businesses and we like buying stocks.
And later on the program, Warren Buffett answers questions from you, our Nightly Business Report viewers. Now, with the Dow closing in on an all-time high, how should you play the rally? Scott Wren is Senior Equity Strategist at Wells Fargo Advisors, and he joins us now. Mr. Wren, welcome. Good to have you with us.
How are you, Tyler?
I am terrific, thank you. You know, Warren Buffett says he still sees value in equities today. Do you? And if so, where?
Well, you know, stocks are below, if you look at a PE basis, they're below the historical average. They certainly aren't as cheap as they were a couple of years ago. But for our clients, what we want them investing in are things that are still sensitive to the recovery here in the States, the recovery globally, sector-wise, the consumer discretionary sector, you know, even something like home improvement retail inside of that sector. It's ran a lot. It's ran pretty hard, but it still looks good in our work. I think it has more upside. Things like materials, diversified chemicals in there. Also technology, IT consulting and services, that particular industry group. So I think there's a lot of choices out there, Tyler, that are sensitive to the economy, not only here in the States, but internationally. They're not overvalued. And, you know, certainly the Fed having the markets back, or at least that's what I would term it, doesn't hurt either.
But, you know, Scott, here we've got the sequester today. We have a lot of worries about what's going to happen in the job market, and the market is rallying. I mean, what's driving this rally?
Well, Susie, really, if you look at the sequester amount, $1.2 trillion over 10 years, the CBO says, you know, already legislated, we're going to spend about $45 trillion over the next 10 years. So really, you know, 1.2, in my opinion, is a really small amount. I think the market knows that. I think while it is going to create some headwinds, maybe you see a couple of tenths percent GDP or something like that, that's a headwind, but it's not going to stop the economy. I think we'll see about 2.5% growth this year. So really, the market's been able to shrug that off. I think the market's pretty convinced that really we're not probably going to see many cuts to entitlements, many cuts to spending. You can easily make the argument that down the road that's going to be trouble, but for the next 12 to 24 months, I think the market's likely to do okay.
Quick final question, Scott. Are you worried at all about the pace of consumer spending with the expiration of the payroll tax cut? That's number one. And number two, are you seeing any areas that you think are highly overvalued today?
Well, I think what I want to do is stay away from the defensives. Really, we've had a good rally so far this year, but, healthcare and staples have led the way, and I don't think that's going to hold. So, those two sectors are defensive. I don't think they're going to hold up through the course of the whole year. But consumer spending, confidence is way up. Housing prices are rising. Consumer spending has surprised me, and I think it's going to continue to surprise the market as we move through the year. I think it's going to be up. It's not going to surge, but it's going to be enough to put the economy into that modest growth kind of territory.
Scott Wren, thank you very much.
Well,
all right, thanks, guys.
Speaking of sequester, today is the first business day where the government's automatic budget cuts, known as sequestration, took effect. The $85 billion in cuts officially began Friday night. Now, although no talks are scheduled to try to end the spending cuts, at today's first cabinet meeting of his second term, President Obama spoke about the potential impact on federal agencies and the American people.
We are going to manage it as best we can to try to minimize the impacts on American families, but it's not the right way for us to go about deficit reduction. It makes sense for us to take a balanced approach that takes a long view and doesn't reduce our commitment to things like education and basic research that will help us grow over the long term.
Meanwhile, a new survey from the National Association for Business Economics shows a majority of economists are opposed to the automatic sequester cuts, but say Washington does need a sound plan to reduce the nation's budget deficit. Well, joining us now to discuss the impact of the sequester spending cuts, we're happy to have with us Representative Ed Royce. He's a Republican from California. Congressman Royce is also a senior member of the Financial Services Committee. Welcome, Congressman. Let me begin by asking you that Raytheon is a big employer in your district. So were you getting calls from employees of Raytheon today, and what were you saying to them?
Susie, I didn't get any calls from employees of Raytheon, but I think that most people understand at this point that we just saw a massive increase in taxes at the end of the year. The president got what he wanted, huge tax increases. And if you think about it, when we're running deficits of over $1 trillion a year, and the question under the sequester, a proposal that came from the White House that he put forward to have a 2% reduction, which is really just a reduction in the growth of government, but a 2% reduction. That's not a tremendous amount of money, but it would get us back on the glide path towards a balanced budget. This is why, from our standpoint, we would like to see that 2% done more rationally. We've twice passed legislation into the Senate to rationally allocate those cuts, but the Senate hasn't taken up a budget for 4 years, so we don't have a partner there. So now we're looking at legislation that would give the president the authorization to make the cuts in the bureaucracy, in the government agencies, or reduce that rate of growth. A more rational approach than this one. So we all agree that this approach is not the best approach, but it originated in the White House. And now we have the White House saying, no, rather than this, we want to have further tax increases. He does not want to cut spending on anything. And that's a big problem given the trajectory.
Congressman Royce, when you put together these spending cuts, plus the ones that were taken back in 2011 and the tax increases from earlier this year, you get pretty close to that $4 trillion in deficit reduction that was part of the so-called grand bargain idea of a couple of years ago. How worried are you that level of fiscal tightening is going to affect the economy dramatically and cost jobs?
Here's what I think the market was worried about, and that is the uncertainty created by deficits that just seem to compound. A $16 trillion debt now that over the last 4 years has ramped up at an incredible rate of speed. What this is actually doing is sending the message, if we can manage just a 2% reduction, that at least we can turn the corner and we can bring that glide path back down towards balance. And I think that reassures the market. I think that brings money in off the sidelines where they say it might be the case that they're going to change that appetite for ever more reckless spending. And you noticed the concern that economists have raised with this being unsustainable. They say 10 years out, you could have an implosion if we don't change this course. So this now begins to do that. I just wish we could reach an agreement where they're targeted. Like the legislation we've passed over in the Senate, and we're still working to try to target the cuts.
All right, Congressman Royce, thank you very much for being with us this evening.
Thanks for the opportunity.
We appreciate it. And coming up, we take a look at things that are working and not working in the U.S. economy. In focus, the American recovery. Now let's take a look at how the markets fared overseas this day.
Well, as you probably noticed, tonight is the beginning of a new chapter for Nightly Business Report, and I have a new partner, Tyler Matheson, and we have a new owner, CNBC, and we have a new set right here at CNBC headquarters in Englewood Cliffs, New Jersey. But we will still bring you the same thing that Nightly Business Report has been giving you for the last 34 years. In-depth analysis of the top business stories of the day delivered in an objective way. And Tyler, I've got to say, it's great to be sitting next to you again. We haven't done this together since 15 years ago.
It is great to have you back home here on our location.
That.
It's great to be back with you, Susie, as well. As you know, that new chapter does begin this evening, but one thing will not change, and that is NBR's commitment to public television, and as the saying goes, to viewers like you. We understand, and I understand, that you watch because you trust, and you've trusted NBR. For 34 years now, we aim to honor that legacy and give you the best, most complete business news show on television every night. Great to be here with you, Susie. All right, in our market focus tonight, we begin with oil flirting with $90 a barrel, the first time it's been that low since Christmas time. Major energy stocks followed the price down with one exception. That would be Hess Oil, up a big penny. Up more than 3%, though, in percentage terms, 38% over the past 6 months. Now, the Hess board boosted the dividend to $1 a share from 40 cents, started a $4 billion stock buyback, and said it is getting out of the gas station business to focus on exploration. Also in our market focus tonight, the private equity firm KKR nearing a deal to buy the industrial machinery maker Gardner Denver, according to reports. Gardner Denver's stock closed up more than 3.5%, valuing the company at $3.6 billion. Gardner Denver makes air handling systems and pumps, among other products.
And another company's making news today. MBIA, that's the muni bond insurer, rocketed up 24% on news that a court had dismissed a lawsuit against the company's business strategy. Shares ended the day up about $2.50. HSBC losing ground after its 2012 profit fell 6%. Below forecast, Europe's largest bank will increase its dividend by 11%. And pharma company Elan trying to hold off a takeover, offering shareholders 20% of the royalties on its multiple sclerosis drug. Shares rose better than 3%.
Tonight, NBR kicks off a week-long series called In Focus, the American Recovery. The key question, to paraphrase the late New York Mayor Ed Koch, how are we doing? Here's Carl Quintanilla with a look at what's going right in the economy and what's not.
That sound you hear is the American economic recovery at its sweetest. The hammers and drills of the housing market. Across the country, the median price of a home is up 7% in just the past year. Sales of existing homes are at multi-year highs. And since housing is about a fifth of GDP, it may be the best thing we have going.
As the housing starts to bottom and recover, that's driver of the economy, because at the end of the day, Americans have more of their net worth in their house than any other asset. And so this is a huge part of the confidence, the rebuilding of confidence.
Housing's one of three pillars that are responsible for the recovery as we know it. Autos is another. The revitalization of the big three car makers hasn't brought many new plants, but it has brought new production. An estimated 15.5 million units this year, up from just 10.5 million at the lows. Some call it the new center of gravity of a manufacturing renaissance. Also working, high-end retail. Sales at names like Macy's, Saks, and Michael Kors suggest the wealthy in this country are holding up their end of the consumer spending bargain.
That 1% of the population that's going to those high-end retailers really has recovered the fastest from the financial crisis, and they're out there and they're spending money.
But there's plenty that's not working. Despite the strength of the stock market, Wall Street banks are retrenching, laying off workers, adjusting to an environment where return on equity isn't what it once was. Big-ticket exports to countries like China have been a challenge for companies like Caterpillar, facing a new wave of lower-cost competition. And for all the enthusiasm about natural gas in this country, some say regulatory uncertainty has kept a lid on production, handicapping what may be one of the biggest long-term goals, energy independence.
We've seen some signs of improvement.
In the end, the main uncertainty to this recovery involves this man, Ben Bernanke and the Federal Reserve.
We are getting some traction in the housing market.
If the economy truly gains traction, when and how does the Fed pull back on its monetary stimulus? What happens to mortgage rates, to government debt payments? In short, can the economy survive the Fed's Band-Aid coming off? 4 years after a bruising economic crisis, no one, it seems, has a good answer for that. Carl Quintanilla for Nightly Business Report, New York.
And here with his take on several of those issues is Ken Rogoff. He's professor of economics at Harvard University. Hi, Ken. You heard Carl's report. How would you describe the health of the economy and also how we're doing in this American recovery?
Well, we have a modest recovery that's stable, and I think that's encouraging people because it doesn't feel like the floor is about to fall out. On the other hand, it's not booming either, and I'm not sure there's really any reason to believe that it's going to be booming anytime in the next few years. So the markets are up because at least some of the uncertainty has been pulled back. Even the mediocre sequestration in Washington, some decision, and we have the very low interest rates, but it doesn't mean that things are going to be fantastic for everyone.
How worried are you, Mr. Rogoff, about the sequestration cuts to spending, the tax hikes that kicked in earlier this year, and the other budget cuts that were taken back in 2011? How worried are you that they are going to slow what you describe already as a tepid recovery?
Well, I think they have been slowing the recovery a bit. There's been fiscal restraint. On the other hand, the deficit was so big, and it's not a free lunch. You can't just have the debt grow forever. There was going to be some scaling back. Obviously, we'd like to see it done in a more rational way. The grand bargain they're talking about, fixing the tax system. There are things the government does we need. And in some sense, the sequestration is sticking needles everywhere in the economy to see who hurts. So certainly things could be a lot better, but I don't think they're such that they're going to upend the modest recovery.
Ken, a lot of people are very worried about what this sequestration is going to mean for jobs. And as you know, we have the February employment report coming out on this Friday. A lot of people expect that the unemployment rate will stay at that 7.9%. So looking ahead over the next couple of months, how's the job market going to do with the sequestration? Better, worse, the same?
Oh, I think the sequestration will hurt jobs a little bit for a year, for a long time to come. I think it's already hurt jobs with some of the uncertainty. We're likely to continue to see this sort of modest improvement that shows us many, many years away from even getting to 6.5% unemployment, which might be the new normal here. So the sequestration, it isn't just the fiscal tightening, it's just the fact they can't come to coherent policy. What do we need to invest in infrastructure, education? How can we improve our tax system? That's kind of depressing, but the market seems to be saying, look, I'd rather have a mediocre plan than no plan.
All right, we're going to have to leave it there. Ken, thank you so much. Ken Rogoff.
Thank you and congratulations.
Thank you for saying that. And he is Harvard professor of economics, author, and economist.
All righty, tomorrow on a Nightly Business Report, we continue our special report, The American Recovery, with an in-depth look at the housing sector. But coming up, long before that, the Oracle of Omaha answers your questions. Warren Buffett Unplugged, next. But first, let's look at today's winners and losers on the S&P 500.
You asked and Warren Buffett answered. We asked you, our viewers, to send in questions for the Oracle of Omaha. The questions poured in on everything from what can be done about the national debt to how to save for retirement. Becky Quick sat down with the CEO of Berkshire Hathaway, and here's what he had to say to you.
Susie, thank you very much. We are with Warren Buffett just outside Omaha, Nebraska, at the Fulfillment Center for Oriental Trading. This is one of Berkshire Hathaway's most recent acquisitions. It's not the most recent, that would be Heinz, but Oriental Trading was purchased in the fourth quarter back in November for about $500 million by Berkshire Hathaway. And again, we are fortunate enough to be sitting down with Mr. Buffett. Warren, we had several viewers from NBR who wrote in and who had questions for you. And if you don't mind answering a few of them?
Let's do it.
Okay, let's jump right in. The first question comes from Tim Reed, who asks, what's your view on the national debt? Is it something that can ever be paid down, and how important is it to do so?
Yeah, it's not important to pay it down. It's important to keep it from rising consistently as a percentage of GDP. But obviously, a growing country can always handle a growing amount of debt as long as it doesn't grow faster than the country does. And until fairly recently, we've been doing well in that respect, but in the last few years, it started to gallop upwards, and it's important that we get it to level off here in the fairly near future. But Berkshire can take a lot of debt. It couldn't take a lot of debt 40 or 50 years ago, but now it has a lot of earning power, and this country has a lot of earning power.
Okay. Here's another question that comes in. This one's from Kersey Billamoria, who writes, what specifically would you recommend to do to fix our entitlement programs like Medicare?
Well, the bigger problem with Medicare is the whole health care system. And as long as the health care system is eating up 17.5% of our GDP, which is far more than happened anyplace else in the world, we are going to have a problem with paying for it, whether it's paid by the government or by corporations or by individuals. And that is the ultimate problem. And unless we get that under control, we are going to be facing problems, whether at the individual level, corporate level, or the government level with our health care costs.
Okay, there's another question that comes in from David Waite, who asks, I've been a very successful investor who averages 18% over the last 17 years. Wow. But right now, everything looks too rich for my blood. Isn't that a bad sign?
Well, it may be a bad sign for him. Everything doesn't look too rich for my blood. Plenty of things do. But there are lots of investments out there that I like for the long term at very good businesses selling at reasonable multiples of earnings.
18% though, is that a really high, I mean, that's a high bar to jump over.
If he's been making 18%, there'll be a line in front of his door.
Okay. Finally, there's a question that comes in from Kyle Stranahan, who says, I'm graduating college this May. Are you hiring?
We're hiring at some of our companies. Well, probably at Geico we'll add 1,000 people net this year. And of course, if we lose it, there's some turnover too. So we're going to add a lot of people there. We're going to add, we have 288,000 employees. I don't know what our turnover is, but I'll bet it's 30 or 40,000, out of those. So we hire that many just to replenish what we need. And then some of the companies are growing. So sure, we're hiring at a lot of companies.
Warren, I want to thank you very much for joining us on Nightly Business Report.
Thanks, it's been a pleasure.
It has been. Susie, I'll send it back to you and Tyler.
Becky, thank you very much. One last item about Warren Buffett. He is richer than he was a year ago by $9.5 billion, but he fell by one spot in the Forbes ranking out today of the world's richest people. His $53.5 billion net worth was good for fourth place. It's the first time since 2000 that Buffett hasn't been in the top three. The Spanish retailer Amancio Ortega, worth $57 billion, edged out Buffett for third. The top two remain the same as in 2012. Mexico's Carlos Slim at $73 billion, Bill Gates at $67 billion in second, and Oracle's Larry Ellison was fifth at $43 billion. In case you were wondering, there are 1,426 billionaires worldwide by Forbes' count, 200 more than just a year ago. And before we go, we want to point out that NBR.com has a new feel. When you log into NBR.com, you'll see our Facebook page where you will still be able to view full programs and post your comments. Again, it is still NBR.com.
And that's Nightly Business Report for Monday, March 4th. And we want to remind you, this is the time of year your public television station seeks your support.
Good night, everyone.
I'm Susie Garrett with an NBR News Brief. All the major stock averages climbed higher today, with the Dow now within 40 points of an all-time closing high. Investors turned around early losses, shrugging off the start of automatic federal spending cuts and concerns about China's efforts to crack down on rising home prices. If you plan to fly, get to the airport early. Homeland Security Secretary Janet Napolitano says the sequester cuts are already causing long lines at customs checkpoints in Chicago, Los Angeles, Miami, New York, and Atlanta. Mexican telecom mogul Carlos Slim topped Forbes magazine's list of the world's richest billionaires for the fourth year in a row, with a net worth of $73 billion. Microsoft's Bill Gates and Spanish fashion retailer Amancio Ortega round out the top three. For more financial news, tune into NBR weeknights on this public television station.